Oh, how you been? It's been some time since we did our last podcast here. Uh, had a little bit of stuff going on, busy with things to organize, meetings, all that shit. As always, busy with business. Um,
Exactly.
but yeah, what's going on?
Has been a long time, bro. I'm not gonna lie. It's been a long, long time. I think it's 8 months last time we recorded a video together. But
Oh,
as you said, life goes on, a lot of stuff going on, markets, building different models, different strategies, a lot
yeah.
of meetings with the investors and quants, and so there's no time for a podcast.
Yeah. Yeah, I mean this is
But
only a little
yeah,
side thing, but uh yeah, it's nice to give some to have some cred. Like 8 months ago, we said this and this is going to play out. And if you
exactly.
look at it, things played
XLF
out.
trade. The
Yeah.
XLF trade, we called it after the crash in April, after the announcement, and the XLF has been running and running and running. So I hope you took it, guys. But no,
Yeah,
it's
but
we thought it's end of year, Christmas is over, so let's get let's chat a little bit about markets. And while we are doing that, why not record it and just so you got our thinking, what we think will happen in 2026
yeah,
and how
exactly.
we
So
are
as like yeah,
positioned.
a little overview for anybody watching. So what we're gonna do is just chat a little bit how the year has been, and then talk about 2026 because I think 2026 is gonna be very interesting. Gonna be interesting in
Exactly. Yeah.
terms of developments, what's gonna happen, and our little predictions. And then you can follow them, of course, and see how well they were.
Yeah.
Yeah.
So tell me what's your biggest lecture in 2026? I know you have an amazing year. I don't know if you want to tell the audience your performance, but I'm very
I mean.
proud. You should be proud too.
It's yeah, it's gone quite good in terms of also like from where I started like 2 years ago or so from the knowledge and to now was quite a big change. But I think the most important thing is like for myself, no matter which area you're interested in, which niche you're interested in, this is what you got to specialize on. For example, you do mostly the macro stuff. I learned stick to the micro, stick to the single name stories, single like companies, do a deep dive into these companies, and then I can trade around the company after I know the company really, really well and know like, all right, this price is not reasonable, or maybe they're getting too expensive. And many people say just invest, don't trade the name. But for me, I think if you really know the company, you know every single thing that is going on with them, you know which headlines are moving the company right now, then after you've done your deep dive, you can decide, all right, is this maybe a reasonable sell-off, or maybe I want to get used this as a buying opportunity. And this is what has driven my performance, like finding single names, really diving deep into them, and then using like my experience with the company, with the ticker, to trade around it. Like, I don't know, for example, 1 year, 1.5 years ago, I started looking into Tiger Brokers, or Up Fintech is under the ticker Tiger, TIGR. And just from the time looking at the company and following them, you know sometimes when which price they should be reasonably trading in, and then whenever they get too expensive, you know, all right, time to pull back a little bit, or whenever they get super cheap and there is not like a big change in the story, then all right, time to get more exposure into the stock. And I think this is what's been working really well for me, is to yeah stick with what I know and to specialize into these little niches that I myself know the best. And I think for you it's with macro, like you know where things should be trading or what things are moving the markets right now.
Exactly.
Yeah, and if something
Exactly.
like moves out of the ordinary, then you know how to profit from that. So
Yeah,
I think that's the biggest lesson for me. Yeah.
exactly. So for me, it's simple, as you said. I also look. It's the same. You use companies. I look at FX pairs at the euro.
Yeah.
So going into 2025, let's recap the year. So we can capture the lessons. So going into 2025, if you remember, everyone was talking about euro dollar parity, and the euro was trading at almost 1.1, and we will see soon euro dollar trading at 1. And if you follow the pairs, if you follow macro, if you follow interest rates differentials, growth differentials, if you have your own models, you kind of, after a while, you kind of start to understand where things should be trading at. And it's the same, man. Like you dive deep into companies, I dive deep into countries.
Hmm.
So it's basically the same. I follow uh, 6, 7, 8 countries and look at their growth, their inflation, at their rates, at their fiscal situation, political situation, and then I try to find investing opportunities in these countries. I don't do a deep dive on specific companies. If I'm looking to invest in the banking sector in let's say in UK, so I buy the ETF. And if
Hmm.
I want to get more returns, I just lever up the performance, lever up the position using financial derivatives like options or other, and just manage the volatility around the position. That's it. This is what we do. So, can you tell us about your process? How do you, let's say you find Tiger, or I know you had another big trade in ZIM,
Yeah, yeah.
ZIM. How did you like? How did you find the company? Because trading macro is a little bit easier. The facts are in front of you. The euro is there, the dollar is there, the yen is there.
Yeah.
But
So
trading these micro structures, it's quite tough to find the right companies.
So I think for finding them, it always comes with like the general idea. So for example, you say, this sector, like this is when like from the macro side, you see, this sector seems to be undervalued or has been lagging, but should theoretically be performing better. And then you know, okay, maybe let's look into industrials or the materials sector. Then you go, all right, look at the biggest, most important companies, and then from there on, you just have to find, all right, which companies maybe have run, like have more room to run, and it's just a lot of work, like going through the different companies, seeing what comes across your desk, like what names pop up on the headlines. You see like the most recent developments in the sector, and then you follow the maybe the industry which you want to invest in a little bit. And then from there on, you get like this broader picture of which are the most important companies, which companies do what, like how they relate to each other. And then afterwards, I use a lot of the Morningstar research. It just gives a great overview. And I try not to be too biased based on their own like the rating of a stock, if it's undervalued or overvalued or so on, but it gives a general like good overview, just reading through a lot of other analysts' reports. And then whenever I find something that sounds interesting in terms of like there could be an opportunity there, then I will start doing my own, like the own analysis, the own report into the company. So it always starts, yeah, the idea comes from a macro perspective or maybe from a headline you read, and then like you read an important headline, and this could then, of course, you have to understand the headline, and this could have an impact on these and these industries or so and so companies. And then you have to look into the industry and find the specific companies through reading the headlines, reading the research reports, and so on. And then afterwards, it's just getting to know the company, following all the 10Ks, the 10, the like the annuals and quarterly reports, and then um, I don't know, it goes as deep as like I
Yeah.
don't know, connecting with somebody on LinkedIn, chatting with the some analysts about the companies, or like writing out some emails to some funds that have holdings in the company or so on, which I find very, very interesting about this because it's kind of like a you do a little bit of journalism. You find a
This
company,
is good. This is
yeah,
good, man. This is good. Keep going. Yeah, it's good.
like you find a company, and then you just if there's an opportunity, you dive deeper and deeper, and then obviously you can get all the superficial knowledge that anybody else can get out there, But firstly, you have to be the person who judges the knowledge. You have to have good judgment in terms of if the company has a future or does not. And of course, there are different metrics, but it's also like a gut feeling that you develop through like reading through so many analyst reports or research reports. Um, but then at some point, you have read through everything. You think, oh, this is good. This is my thesis. This is my theory for this company. But there's always this like for myself, I feel like there's always this little, in terms of a doubt, where, yeah, I think this company is very undervalued, but why isn't the market thinking that? And then I start to maybe get in contact with like other analysts or also talking about like talking to executives of the company or managers that like they say, of course, they're managers, so they want to speak good about their own company. But they will say, oh, okay, those and those are our opportunities, and we think the company should be good for the future and so on. And this is then where you can decide, all right, maybe another analyst sees a risk that you haven't seen yet. And then you just have to evaluate, all right, is this risk really that big? So is it a reason not to invest? Or do you think the analysts may be over exaggerating that risk? And then yeah, you have to see how it works out. And for
It's
me,
good. And
like
that's, yeah,
yeah, like for a specific example, what you said about Zim, ZEM, it's a company in the shipping, maritime shipping sector, and the whole industry has been like in a super downtrend since 21 or so, like the post-COVID boom, or like there was a huge boom in picking up, like the industry picked back up and shipping the freight rates, so the cost of shipping a container and so on went up immensely, and therefore all the shipping companies did really well because they had better margins and so on. But after the market and the global economy normalized a little bit again, the freight rates came down, of course. So therefore, the whole sector is currently in a downtrend. And I just it just came across my desk, Zim, as like an investment opportunity. It looked super undervalued in terms of mm, if you look at the multiples where they are trading, it looked super undervalued. And then for me, it started, I was digging into them, I was digging into the management, I was digging into the industry, into their strengths and their weaknesses and so on. And I decided for myself, all right, I'm going to start with a position in the company. I just like wrote some puts on it in order to get assigned and to get into the stock, as we usually do. And then from there on, the whole story developed. Like I, of course, kept following the company when I decided, all right, when do I want to add to my position, or maybe when do I want to like de-risk a little bit, and so on. And then recently, the story developed that the management has been seeing this undervaluation of the company as well. And there's currently a buyout process going on into the stock where there's like on the one side, there's a management buyout deal, or like a MBO, management buyouts, um, which the CEO and some investor wants to buy the company. But then on the other side, there are also like other companies that are interested, like other shipping companies, to buy the stock company and take them private or like acquire them. And this has been going quite good for shareholders because usually like the company is trading so cheaply, the stock is so cheap because of this like downturn in the general industry. Um, but this is not a price that any management would accept. So
yeah.
there's a good amount of upside for the company for
Then you got this,
if they get bought out. Yeah.
then you got this catalyst of this MBO and the stock
Yeah.
skyrockets, and everyone who is not in the position starts going bid and want to get into the stock, and this is how you create also a squeeze.
Yeah,
Anyone would say
exactly.
it's quite it's luck because you didn't know that this thing would happen, but I would disagree. If you put in the work, if you really trust your process, you will get lucky
It was
99% of
also
the time.
yeah, in this company, oh yeah, exactly. You will get lucky 99% of the time if you have a proper
Exactly.
due diligence or like a proper research process. It was also that, yes, everybody like so back in August, I think it was, there were rumors that the CEO wants to buy out the company and wants to take it private, but nobody like there was a slight little pop in the stock, but it faded again. but because the information was there and it made sense to me that the CEO would want to take the company private, because it's so undervalued. But the market just didn't seem to realize that yet. But now the reality has caught up to them. They're like the rumors they have substantiated. The CEO has made an offer, and there's like negotiations going on and so on. So yeah, if you have a good process, then you will get lucky 99% of the times.
Congrats, man. Sounds good. Congrats, bro.
Yeah. But well, what about you? What has been going on? What are the most interesting trades or the most like crazy stories that you followed or traded around? Yeah.
For me, it was a quite a good year. It was a very, very good year. Like it's the best year in my entire career till now. Again, if going into 2025, if you remember, everyone was trading the Trump trade with crypto, Bitcoin,
Mm,
stocks to the moon, growth expectation getting revised up, everyone thinking we'll get higher growth because of the deregulation and the Trump policy. And then we had this euphoric rally in the markets, if you remember, which also went into the dollar that gave me a lot of opportunities in the FX space, especially being long the euro because my portfolio is in euros and
mm.
I just manufacture my dollars using derivatives to get the American exposure without having any currency risk. So it was beautiful because I was in the euro, took the entire move with from one from almost talking about parity to 1.2 on the euro. I also was short the market before the pop in April, before the Liberation Day took place. If you remember, it was in February, and we were at your place. We're sitting down having a meeting with the guys, and then we got one PMI data that turned the entire market into risk off, if you remember it.
Well,
And
yeah, but it
then,
was some time ago, but yeah.
yeah, everything went risk off. I look at the market, and we were talking, we were trading at the time. We're in the session intraday, and then I looked at the market, seeing the VIX is popping, SPY is falling, NQs are falling, Bitcoin is falling. XLP was performing, which is actually the lagger this year. It was the outperformer at the beginning of the year. And this was for me, okay, it's time to go risk off. So I went short junk bonds and with leverage, I was in long TLT duration, the long TLT, the long duration trade. It also worked off because it was a classical risk off moment. And I made a couple thousand% just because the credit spreads widened with the option that I got on the junk bonds. So it was a beautiful trade. And then after the April washout, everything stabilized. I went long Japanese banks. I went long the Nikkei. I went long XLF. I went long. I missed the initial bottom on the SPY, to be honest. It was a mistake. If you remember, we sold the day the market
Yeah,
bottoms because here's the thing. It was such a tough times when we couldn't take it. I couldn't take it anymore. I was sitting there seeing the market trading lower, hearing the analysts on Wall Street and even retail traders were like scared. Everyone was
yeah.
scared. The market took a dump in 3 days like never seen before. And I was short. Like don't get me wrong, I was doing good, but the amount of money that I saw, it took my mind out of my skull. So it was like, okay, I need to go flat. I need to reset. I need to reset my brain. It was a
Mm.
lot of stress. I couldn't sleep for 3 4 days. And then we exited. A couple hours later, Trump decided to
Yeah,
push the tariffs. The market bottoms. The market comes down.
I think it was like a 10% something.
Yeah,
Like
in one
it
day.
was insane.
Insane.
Yeah.
And here's the thing, we were day trading also like that. And to that time, we were in the session doing intraday stuff, which is good if you know what you are doing, but not at
But
times where
it's
volatility or
it's too
VIX
stressful. It's
too
not
stressful.
it,
VIX
not it.
exactly VIX trading at 60, and we were in the session. It was too much, man. And then I went mentally, I went off. Then got back in June, and then I had a couple good trades. I had gold once we broke out in August after Jackson Hole, where Paul went guns blazing with his talk about debasement, and he actually triggered the debasement narrative. And then gold has been a good performer. I got out at 4,200, and then I shorted the gold at 4,300. I had copper also. Copper was a good long after the washout with the tariffs announcements. Yeah, man. I have been long oil, but the trade is not working out.
Yeah, I
Has
mean
been
oil, it's difficult.
pain.
It's so many things that are like influencing it right now, or
Exactly.
not right now, but in general, because it's yeah, it's
I wish
complicated.
Noel, I wish Noel
Yeah.
had were here with us because he is the oil analyst at the firm. He takes care of that. And even he got it the beginning wrong. And Noel is a good analyst, to be honest. He is a good oil trader. He got it wrong at the beginning. And then he came to me and said, hey, listen, we are on the wrong side. If we can't exit the position, let's hedge it. And let's at least bring our delta to zero. And this is what we have done. It has been a painful trade, man. Let's see what 2026 brings
Well,
with it.
so
So
speaking about 2026, what is the I mean, everybody now towards the year end is like, oh, this is the one industry or the one sector for 2026, or just buy this stock and you're good. Well, what are you saying? What are the most important things to look out for, or what are the biggest forces influencing the market or different industries and sectors?
from a macro perspective, if you look at the last 2 months, what we have been seeing is the market's going flat. This is because liquidity is drying up on the repo markets, and we see the stress in the SOFR spreads. Like I'm looking at right now, we are a little bit in danger zone on the SOFR to the AFFR spread. This is why also this usually drying up in liquidity causes multiple contraction, and we have a market that's overbought from a fundamental perspective. If you look at it, the valuation are trading at almost 50, 60 years high. Um, so liquidity drying up, it's a big problem. This is why also the Fed stepped in, if you remember, in their October meeting and
Yeah, they
decided
started
to
adding, yeah,
exactly adding short-term bills just to support the money market. And there is a difference between short-term bills and buying and QE, as everyone is talking about. But we can explain it in another podcast. Another
so
point was that caused the market to stay flat is the growth slowing down because we had no data because of the government shutdown. We had no data to see if there is an upside surprise on growth that causes the market to push up, and we got it. Last week we got GDP, Q3 GDP coming in at 4.3%, which caused the SPY to put in new all-time high, to break into new all-time high territories because we got an upside surprise on growth. Um, So what I think is going to happen is the following. There is the Goldilocks environment that we are trading in currently right now. And I published a report on the Substack. I'll put the link down in the description. You can read about it. I think we are going into Goldilocks globally, which means growth is gonna reaccelerate, inflation is gonna stay the same, and we will see unemployment maybe falling down. And this is what the market is projecting, but also central banks globally. Um, just by looking at where inflation is in the United States, the November readings came in at 2.7 and core at 2.6, which is the opposite of what the market was expecting. 3% was the expectation. There is a downside surprise on inflation. So this disinflationary process continues. An upside surprise on GDP, 4.3, which is mainly caused by consumption and the trade balance improving. And this is also what the Fed SCP is showing from the last meeting in, I believe it was in December, 10th of December. We saw them upgrading growth. So their growth projection went up, downgrading inflation and keeping unemployment the same. And the short-term interest rates market, if you look at the SOFR or if you look at the ZQ contract, they are pricing 72 basis points worth of cut next year.
not a lot.
This,
Like
which is not a lot. But if you have Goldilocks, you don't need a lot of
Yeah, because if the
funds.
growth keeps going, then
Exactly.
like they don't need to worry that much about the labor market. It's like
Exactly.
it's all right. Yeah, yeah.
But there is this narrative. I will get back to it. We'll talk in detail a little bit about the Fed, but let me keep talking about the rest of the market or the rest of the globe. Got the same thing taking place in Europe. ECB also GDP projection up. Um, Inflation is still the same. Uh, the market is pricing right now, and if I look at it, the short-term contracts, absolutely nothing from the ECB. So unless we get growth differentials from the US and the Eurozone differentiating in a big
Mhm.
way, the euro should make new highs. The
But
projection
how
from the
how is
ECB,
growth looking in Europe right now? Like, what are the GDP projections and like what's the outlook?
so in the last SEP, the projection from the ECB, from the central bank, went by up like 0.2%. They
Hmm.
expect the growth to be at 1.2 in 2026, which is 20% higher from last reading, the rate of change in the
Hmm.
projection. And what people don't understand in macro is that the central bank events, ECB, Fed, RPA, these are the inflection points in the cycle, usually. If you remember, at the January, yeah, I think it was the January meeting, the Fed, like this year, the Fed projected stagflation. They downgraded
Hmm.
growth. The first time they downgraded growth, they upgraded, lifted up their inflation forecast. And what we have been seeing since then, gold has been performing, which was our call out, if you remember, last year. We called it. We said gold gonna be the best performer this year because of the stagflationary environment we are in. And this is what happens. The Fed told you what to do. Right now, I see Goldilocks from the
Yeah.
Fed.
Fed is saying,
But what
"Oh,
I
GDP, we're gonna grow, grow,
exactly,
grow," and inflation
exactly.
looks like it's pretty good. So
Yeah.
yeah,
Yeah, we see bear steepening taking place in the Eurozone, which is actually telling you, listen, we might grow, but the growth that we will see or that are going to experience is going to be mainly due to inflation. If commodities rise, and this is also what we have been seeing, is that commodities breaking out. If you
yeah,
look at the
yeah.
BCD
BCD,
ETF,
yeah, the
exactly.
Bloomberg
This is,
commodities.
yeah, we have a long position after this breakout. We see commodities breaking out, which is also positive for growth or a pro-cyclical type of growth, but it will come at cost, and cost is going to be inflation. Um, and this is also very interesting because if you connect the dot, you see that the New Zealand dollar, Australian dollar, and the
Mhm.
Canadian dollar, these three are undervalued right now. The same way we went into the year where the Swiss franc and the euro were undervalued in 2025. Going into 2026, you have the Australian dollar, New Zealand dollar, and Canadian dollar. They are undervalued, not just on a interest rates differential perspective, because the market for Australia is pricing right now for the RBA two hikes next year. For Canada, we are pricing one hike, and for New Zealand, I think it's also one hike. So the interest rates differential are widening
Widening. Yeah.
compared to the rest of the world. Plus, you got this commodity cycle that's taking place where we see commodity breaking out. And these countries are commodity exporters, which means they are net long commodity. So the appreciation in the commodity prices should help them and their local economies as the
Mhm.
demand for this product is going to increase, the trade balance is going to increase, GDP is going to increase, growth is going to increase, and demand for these currencies is also going to increase.
Yeah.
So this is
Well,
what we are looking
also,
at from FX.
yeah, about our recent report, maybe I think what is interesting, you want to talk about the forecast for the solar ETF 10. So
Exactly.
like the story behind it, maybe like what is connected with it, if it's connected with the reacceleration in growth, or what is the idea or story behind that?
Exactly. So if you look at the report, what I've wrote down is I think we will see Goldilocks, and this is what also the yield curve is telling us. We see a steepening in the yield curve, and I think we'll get to 1 to 1.5 levels at the yield curve. Usually in these times, cyclical industries does perform the best. So you
Hmm.
have biotech, you have XLE, which is industrials. This is also a reason why the maybe the cargo sector, which is the shipment, sea shipment, should also perform well because demand for commodities is going to increase, shipments going to increase around the globe, so you could see more upside for your ZIM trade. Um, and if you have a steepener on the curve, XLI performs, XLF performs because of the net income margin,
Hmm.
and also solar. Solar, to be honest with you, I don't have any fundamental thesis on it yet. But what I have is a momentum thesis. If you look at it, it's one of the best performance this year. If you look at the entire sectors, it's one of the leading
Hmm.
sectors this year. And technically, if you look at the technical charts, I really like it. It's breaking out of a downtrend
Hmm.
into a growth cycle that's going to accelerate with these new projects and these fundamental drivers. Like governments are pushing this renewable energy programs, and
Hmm.
this is why we saw this reversal. I'm interested in it, and I have a price target on it, but I am still thinking on how I want to get into it. What's the best structure?
Hmm.
Because at the end of the report, I wrote down if we see liquidity contraction, which was going to cause multiple contraction, the best, what I think, the best way, and this is what I told my clients, our clients, the best way to do is to go from being long shares to being long out of the money calls. Worst case scenario, you lose the premium if the market crashes going into next year, which I see the possibility for this to happen. But I
So I
also
think, like, yeah,
see the possibility
the
for,
well, talking about the long-term calls or the far out the money leaps, I think this is also a very important part that we started doing differently in terms of how to structure trades is use the convexity for yourself. Like use it to help you with
exactly.
your trades. If you have out the money calls, yes, they are far out the money, but you have time. And if the stock starts or the underlying starts moving your direction, it starts performing how you predicted, then the convexity will exponent or not exponentially, but the further it moves towards your goal, towards your strike, the higher the delta will become and the better your performance on the position will be. And if it moves against you, then well, the delta has already been quite low, and therefore it just gets lower and it moves less and less against you. So I think using like leaps and call like the
Exactly.
far out the money positions has been
Like
quite
15
working quite
delta,
well.
20 delta, 15 delta. It's a good measure. And you can turn the trade risk free. Like this is what I've done on the SPY. I bought seven the 780 leaps for next year. And then as the SPY went up, I sold the 800 calls against them, turned the trade risk free. Now I have a exposure to the upside. If the market decides to go parabolic next year, we see 20% plus, I'm still participating with no risk.
Yeah.
Um, if the market decides to crash, I don't lose anything. But if I don't turn it, even if I didn't sell the calls, if the market decides to crash next year, I lose only the premiums that I paid. Especially at markets that's trading at these levels with cheap volatility. If you look at the VIX, it's trading
Yeah.
at 14.
It's
So
crazy. It's really, really crazy how
uh,
low we've gotten. Like,
so just if you want to stay long, because there's a lot of things that's telling me to stay long into next year. Again, the Goldilocks, the upward projection, the deepening of the curve. So be long, but with leaps, and you get the leverage as Torben explained with
yeah.
the convexity. So why not? Um, yeah. XLI, I think it should perform industrials because of cyclicality, everything is written down in the report. It's not in detail because I keep the rest for our clients, how we structure the trades and what we want to do, how we want to enter the trade, how we want to exit the trade, what delta we pick, what strike we pick, what expiration we pick, what structure, what system. But there's a quite, I think it's quite informative if you read it. And gold. Here's the thing. Everyone asks me about gold.
Yeah,
Bro,
because
I
now
get
everyone, oh,
a lot of
gold is up.
calls.
Yeah.
Exactly. A lot of calls. Everyone. Hey, what should I do? Gold, silver. Let me tell you one thing. If we get into Goldilocks next year, you gotta forget about gold.
Yeah.
It's gonna stay flat. Best case for me, it's gonna be 5,000. Base case gonna be 4,000 something, and worst case gonna be 3,800. If we get next year Goldilocks. But if the stagflationary environment continues and the debasement continues, um, we could see gold continue to perform.
But yeah,
One thing,
I
yeah,
think the run has been too far. I myself once gold started like once it was in everybody's mouth, once everybody knew it, like everybody was talking about it. This is where I decided, okay, gold is not it anymore. I was looking for alternatives. I was looking for like catch up ideas, and I just decided to go with silver. To yes, of course, silver also has some other uses, but as you can see once the story picks up, it's gonna go crazy. It goes crazy, but then once it has gone crazy, it's time to like take
to
your
exit.
win, move on to the next trade, and
Exactly.
then you find something. And then after, if you've done your, as we said, if you're lucky 99% of the time, if you've done your proper research, you will see that like you are in the position and then the news starts breaking. And then afterwards, the news comes out, then you exit your position and you find the next
There's
one.
exactly there's always early signs that things are going to move before they move.
Yeah.
And you gotta be a market professional to see these signs. You gotta put in a lot of time, a lot of effort. And then once they start move, you stay in the trade until you start seeing Instagram reels about certain stuff. This is what happened, man. Like I was in AGI, if you remember, at the beginning
Mhm.
of the year. And once gold went parabolic, I saw some Twitter post about some random guy talking about AGI and how they are going to go to 300, stocks trading at 40. I was like, okay, it's time to exit the trade. I wrote calls. And, once you start seeing everyone's talking about it, the trade's done. It's
Yeah.
it's almost done. Um, it's gonna return because there's low portfolio allocation from money managers in gold. It has been lagging assets over the last 40 years. From 2011 till now, till let me see, because we had 2011 at top, I can remember it. And then it took almost 10 years for gold to break out from that top. And usually after such a breakouts, these commodities goes parabolic because there is an under
Under
allocation
allocation in it.
from
Like if you
yeah,
look at the
exactly.
commodity cycles, they have huge, like decades long downturns or upturns.
Yeah,
But
exactly.
like yeah, with commodities, everything is slow. It takes more time. It's more patient. It's not like tech stocks or something. But
Yeah,
yeah,
it took 10 years. 10 years. 2011 was the top, and then 2020 we got the breakout. Even, sorry, we got it 2024, we got the real breakout. So it's the beginning of a trend in gold that has been going in for 2 years, and it's going to continue over the next 10 years. But be careful.
as
With
always.
that said, anything you want to add, my boy?
Oh, man, I think you said it. Be careful is the best thing. And like,
Be careful.
yeah, using leaps in order to have exposure, but not being overexposed that your whole account can be wiped out. If Trump goes crazy again, who knows? But yeah,
Man, oh man.
well,
Exactly. Yeah, we hope it's going to be a better